Welcome to Financially Speaking, brought to you by Buska Retirement Solutions and its affiliate firms. We offer retirement, tax, and legacy planning from a dedicated family-built team. In today's episode, why it's never too late to start saving for retirement, what you can do if you're approaching retirement age and haven't started saving, and whether or not you should consider investing in the market during retirement. And now for our weekly question and answer segment.
Welcome back to Financially Speaking. Today I'm joined by Cole Bruner and Kaylee Berenson of Buska Retirement Solutions and Buska Wealth Management. And in this segment, we're tackling a big question that weighs heavily on many people, especially those approaching retirement age. Is it ever too late to start saving for retirement? Well, let me ask you, as you go through life, you got kids and it feels like could never get any money saved.
Yeah.
Maybe you feel like you maybe could have saved a little more earlier. Not speaking for myself, but possibly.
Sure.
Is it ever too late where you just give up, or what do you do?
Well, it's never too late to start investing. If we can start earlier, obviously the better we'll be off in the long run. But whether you have 5 years or 45 years until retirement, it still makes sense to take advantage where you can and take those growth opportunities. Even if we are on a shorter time horizon, there are lower risk investments that you can take advantage of those growth opportunities. So just make sure that you're assessing your financial situation and looking into where you can, put some extra funds away is going to be super beneficial in the long run.
Yeah, I mean, you've got to think about where the priorities are. And we always say that, starting early is great, but late is better than never. I mean,
Right.
Getting to retirement and just kind of throwing your hands up like, oh, well, I guess that'll just never be the case for me might not be the best strategy.
Right.
We want to kind of take some time and really figure out what can I invest and what can I potentially put away for my future so that I am at least as prepared as I can be at this stage of life.
You mentioned a shorter or a less volatile vehicle. How do my retirement savings goals change if I'm starting saving later in life versus earlier?
Mm-hmm.
Well, I think in terms of how your goals change, I mean, oftentimes people might be inclined to take an abundance of risk because of the fact that they're starting a little bit later and they're trying to make up for lost time. And although sometimes that strategy can pay off, the one thing that we can't control is the ups and downs of the market.
Sure.
I mean, I think if anything, 2025 has proven to us that volatility is real.
Right.
It
I noticed
happens. Yeah, absolutely. Most people have. But it happens, and unfortunately we can't control the timing of it. And so if it just so happens that you're starting to pump money into retirement accounts later in life and you're trying to catch up and now you're in a really aggressive portfolio and we hit a really rough patch in the market, now all of a sudden that's not really providing you a whole lot of value because of course you're putting money away and then losing money immediately. And so you want to make sure that not only you're putting money away as much as you possibly can, but you're also doing so in the right risk tolerance. That's still a really important part of the plan, is making sure that you're not overexposing yourself to risk with the dollars that you are now saving, so that way you are prepared for whatever the market might throw at you.
So what are options for someone who is close to retirement but has very little saved?
Well, there are, other options that people need to take into consideration. So there are catch-up contributions that a lot of retirement plans offer. And so realizing what type of retirement plan you have and how you can, start to make those catch-up contributions is going to be super beneficial. We know that every retirement plan out there is different. So making sure that you are, researching that or sitting down and talking to somebody, it can be very beneficial in the future just because there's a lot of rules that go into it and it can get very confusing very quickly. So having that, sounding board and that second opinion to make sure that you are thinking about everything the right way will make a big difference for you.
Yeah, and there's a lot of different plans available.
Right.
There's a lot of different options. Each comes with its own rules and regulations. Each comes with its own contribution limits. All of this different stuff matters, obviously. And, the individual that's not necessarily a finance guru might not be aware of some of those intricacies. And so working with a qualified financial professional can really provide that guidance and give you that peace of mind that you're taking advantage of everything that you possibly could, especially if you're starting a little bit later. That becomes even more important.
Something else to consider is also looking at your Social Security options. So if we maybe don't have as much saved as we wanted to as we near retirement, then kind of figuring out the right time to take your Social Security benefit is going to be like super beneficial to you. Just because if we decide maybe we need to work a little bit longer or maybe pick up a part-time job so we can delay that benefit to either full retirement age or even past that. I don't know if a lot of people know that after you reach full retirement age, your benefit does roll up by 8% every year. So you could possibly have, an increase in 24% on your Social Security benefit if we can delay it. So that's another strategy that people should be aware of and look into before deciding when to elect that benefit.
Yeah.
How do you help somebody figure out what type of income they even need in retirement? What do you see happening too? Do most people spend more? Do they spend less?
That's a good question.
How does one even know that?
Yeah, and oftentimes we get asked, is there a certain amount of money that I have to
percentage.
have, right?
Right.
80,
Yeah.
right?
Yeah, right, exactly. 80, 90,
Yep.
whatever it is. And we always say that it's really dependent on the person's lifestyle. I mean, we find oftentimes that we build our lifestyle around the amount of income that we generate. And so
I've noticed that.
Right? Most people do, right? And so the thing that we come to find is sometimes people think that they're going to be able to retire on exponentially less money. And it's like, that may not be the case. I mean, you enjoy going out to eat. You want to, play that golf game once or twice a week. You want to, go up north in the summer and go travel in the winter and all those different things. And all of that costs money. And the thing that we always try to remind clients of is when you retire, all of a sudden you have 40 plus hours of free time that you didn't have before. So you've got to figure out how you're going to fill that free time. And often that means it's going to cost you a little bit more money. And so in terms of creating an income plan and understanding how much income you're going to need, you have to be really realistic with where you think those dollars are going to go as we get into retirement. Are you going to travel more often? Are you going to go see the grandkids and the kids more frequently? And, are you going to buy an RV and, travel around the US? Whatever it might be. What that retirement picture looks like is going to come with a price tag. And so we have to make sure that we're going into retirement with our eyes wide open to understand what that amount will be and how that parlays into what we need to have in retirement account values and what types of investment vehicles we need and what income streams we can expect from them and all of those different things that all fit together to create the most comprehensive and successful retirement plan for you.
Okay, so you guys have done this for years, obviously, and a million times. If you had to boil it down to 3 simple steps or 2 simple steps of what do I do? I can admit I've waited too long to start saving. What should I do?
Well, I think you should definitely take a look at your budget, see where you can cut some expenses to bulk up those retirement accounts, take advantage of catch-up contributions, and then talk to a financial services professional to make sure that you are on the right track and you have a plan in place.
Yeah, I think that last one is incredibly important because, a lot of people don't realize what other opportunities there may be for investment, for, just general account types and things like that to save for your future. And certainly, like you said, we work with this every day. We've been doing it for years. And so we can certainly provide some guidance in terms of what makes the most sense for you individually because there's not a generalized rule. There's not one plan or one strategy that works the best for everybody. As lovely as that would be, it would make everybody's lives a little bit easier. But sadly, that's just not reality. We have to have a customized plan for your personal needs and your circumstances. And then we have to see that plan through for the next 20, 30 plus years.
So if I don't let my pride get in the way, I call and I say, Cole, Kaylee, help me.
Yeah.
I'm not the first guy to make that phone call.
Oh,
No.
right, of course.
Yes, we'll gladly help you.
Most definitely.
Thanks for joining us. And after a short pause, we'll go into more details about catch-up strategies, savings vehicles, and smart budgeting moves that can help late starters build a more secure retirement, no matter their age.
Do you have a plan for how your assets will be handled after you're gone? Without one, the state could end up making life's most important decisions for your family. Through our partnership with the State Guru, we make a estate planning process simple and affordable, offering wills, powers of attorney, and revocable trusts. On average, our service costs 70% less than the traditional estate attorney fees, and you may even qualify for free financial and healthcare power of attorneys. Call our office today to get started.
And now back to our weekly question and answer segment.
Welcome back to our conversation about what it looks like to start saving for retirement later in life. Before the break, Cole and Kaylee reassured us that while time might be tight, it's never too late to make progress, Now let's look at what progress can actually look like. You talked about catch-up provisions.
Yes.
What are they and how do those work?
Yeah, so catch-up contributions are going to be for anybody over the age of 50. Then their retirement plans will allow them to contribute more than the standard limits that the IRS sets. So there are different things that you want to take into consideration when it comes to catch-up contributions, like eligibility and what accounts it applies to, and also the timing of that. So when we look at eligibility, that catch-up contribution has to be made in the year that you turn 50. And then also when we look at the different types of accounts, there's so many different types of retirement accounts as we've already covered. But for today's purposes, I'm going to cover the most common. So like 401ks, Roth IRAs, and IRAs, traditional IRAs. So when we look at the contribution limits, right now the standard limit for a 401k is $23,500. When we look at the catch-up contribution for anybody aged 50 to 59 and then 64 plus, they can put an additional $7,500 into that account. So total for 2025, you can contribute $31,000 to your 401k. Now they did add another special provision for 2025. If you are aged 60 to 63, you can increase that contribution to $11,250. So technically, you could contribute $34,250 for 2025 if you are 60 to 63. But once you hit 64, you drop back down to that $31,000 limit. Right. I know, kind of confusing there.
Right.
Right. But when we look at IRAs and Roths, then that contribution amount right now is going to be $7,000. The contribution catch-up for anyone aged 50 and older is going to be an extra $1,000. So in 2025, you can contribute up to $8,000 in your Roth or traditional IRA. Now, when we look at the timing of those, with your catch-up contributions in your employer-sponsored plans like the 401k, it does need to be in by the end of the calendar year, so by December 31st. You want to make sure that you are talking to your employer to make sure there's no extra forms that you have to fill out. Also inquire about matches that they might do for catch-up contributions, because it is common that they will match those as well. When it comes to your IRAs and your Roth IRAs, you technically have until the end of tax season. So you have until April 15th the following year to still contribute for the previous year. So for example, this year, everybody had until April 15th to still contribute to their IRAs and Roth IRAs for 2024.
How does somebody keep track of this without somebody like you?
Right.
You don't.
I was like, how is the average person supposed to do it?
It is difficult. You know, I mean, when it comes to trying to make sure that you're aware of all of these rules and the fact that they change, because, I mean, they've changed over the last several years.
helps.
Like Kaylee just said, that super catch up for 60 to 63-year-olds, that's brand new. So, I mean, it is difficult for the individual investor to be up to speed on all of these different things and how they adapt and change over the course of time. So, I mean, you know, we say it all the time, but this is why a financial professional working on your behalf is really valuable. Because obviously we have to be knowledgeable and educated on all of these different things so that we can effectively communicate that to our clients and help them to understand how it affects their overall plan and their options for their future.
And what's interesting every time I talk with you guys too is how one thing is never an independent decision.
Right.
It always seems like you can do this, but look out for that. And if you do that, careful with this one. It's always, they're all tied together.
Yep.
Absolutely.
Fascinating. What role can reducing expenses play? Like I'm going to stop spending money in retirement. You talked a little bit about that, or I'm going to downsize my house, or what role does that have? And maybe I can't create more income, but I can drop expenses. Do you see that a lot?
Yeah, so if we can reduce our expenses, then ultimately that's going to increase your monthly cash flow. And so for increasing that cash flow, then you have that money that you could bulk up your retirement accounts, use those catch-up contributions, or maybe increase your savings, emergency funds. Otherwise, maybe focus on some strategic debt reduction. I know it's a big goal of a lot of retirees to not have debt in retirement. So if you can focus on getting those more high interest rate debts paid off before you enter retirement, that's just going to cause a lot less stress for you when you're meeting your monthly expenses. When we look at downsizing, that could be a great option as well. I mean, we are in a different stage of life now. Maybe the kids have moved out and they have homes of their own. Hopefully that's the case, right? That's what we all hope for. But then we can also look at, moving to maybe an area that's less expensive. So if we can downsize, then we're going to reduce our mortgage payment or lower our rent, which will reduce our property taxes and hopefully overall reduce our monthly maintenance costs. And then we can use that money to use it towards things in retirement that maybe we couldn't do while we were working, like take that trip, or we can, take up those hobbies that maybe we didn't have that time for before.
Yeah, or even maybe dedicate that newfound savings to investing, pumping that money into retirement accounts and different things like that that might help with compounding growth, offset some of your future obligations down the road.
Maybe I'll move into my kids' house and eat
There
their
you go.
food and break their stuff.
Perfect.
So how can working with a financial advisor, I come to you guys, how can you help me? What do I need to do? What do you do to help lay this out for me so it is a clear path for me to
Well,
take?
I mean, I think the client's role, your role in this case, is relatively simple. I mean, you just reach out and you schedule a no obligation consultation. You come in, we'll talk through what you've got going on in terms of investments and resources and all of these different types of things. We talk through your goals, your risk objectives, all of that kind of stuff. And then we can help to analyze that situation through a variety of different reporting tools that we use and help to kind of lay the groundwork for beginning to build a financial plan that's customized to your personal situation. So I think there's sometimes a lot of stigma about, being embarrassed or nervous or whatever.
It's a personal thing.
Yeah, absolutely. I mean, I look at it no different than any other conversation with a professional. Like, think about healthcare professionals.
Right.
You've got something going on, you go see the doctor, you're going to tell the doctor everything that's going on so they can diagnose the correct problem and help you address it, right? Well, we're no different, except we're in the financial world. We help do the same types of things. We help diagnose potential issues, we help provide recommendations on solutions, and so it's really no scarier than that, because I mean, we're just individuals, we're just people. We understand the intricacies that we all deal with as individuals, and we can really help to provide guidance with the knowledge and the resources of the industry to be able to provide that professional advice.
What age does someone generally, obviously the earlier the better, but what age generally would you recommend someone comes and talks to you? I mean, let's say you retire at 60, 65, whatever is it? Is it 40? Is it 50? Like, when is a good time?
I think it's different for everybody. I mean, it depends on what you're trying to achieve in retirement, but I'd say generally, I see most people starting around 50, 55. Make sure that they're within, 10 years maybe of that ideal retirement age, so we can start making adjustments now, so when we get to that retirement date down the road, we don't have to push it back because maybe we weren't as prepared as we should have been.
Yeah, absolutely. I mean, you want to be as prepared as possible, and you want to start that plan as early as you can. And a lot of people will start saving earlier, but I think that 50 plus is when we really start to dig into creating that plan, ensuring asset allocation is appropriate, and all of those different things, which become exponentially more important the closer we are to that retirement date. That 10 years leading up to and the 10 years immediately following your retirement date are really the time frame that you definitely don't want to be making mistakes with your finances.
Good. Well, I appreciate that. I feel like everybody at some point feels like they waited too long or didn't save enough or whatever it is, so thanks for making that easy.
Absolutely.
Of course.
We'll be back for more after this with more Financially Speaking.
At Buska, our goal is to streamline the retirement planning process to help you move towards a successful retirement with confidence and ease. Through our 3 companies, we create personalized comprehensive retirement plans by integrating investment management, income planning, tax strategies, estate planning, as well as health insurance and Medicare planning, all under one roof. Call today or visit retirewithbuska.com to schedule your complimentary, no-obligation consultation or to get a second opinion review of your current plan. Let's make retirement planning easier together.
And now our Financially Speaking weekly desk segment.
Welcome back to Financially Speaking. I'm Cole Bruner from Buska Retirement Solutions and Buska Wealth Management, and joining me is Logan Waller. Now today, Logan and I are going to talk to you about why you should have a checklist for personal and tax documents after a natural disaster.
That's right, Cole. Here in Wisconsin, we typically get about 23 tornadoes every year. But as the Milwaukee Journal Sentinel pointed out in 2024, the number of tornadoes that hit our state has almost doubled that. And as a Business Insider article pointed out, natural disasters are a threat to Americans' retirement plans. So, it makes a lot of sense to have a checklist in case some kind of natural disaster strikes so that you can recover fully as possible.
Now, a checklist can go a long way toward helping you navigate post-disaster chaos. Investopedia laid out the details for such a checklist in the article titled Checklist for Personal and Tax Documents After a Natural Disaster. So let's dive a little bit deeper into it.
How about we start with why it's so important to reconstruct lost records after a disaster hits?
Your records are often necessary for getting the reimbursement you need from an insurance company or for claiming federal assistance. You'll also need records so that you can report losses on your tax return.
What types of documents do disaster victims need to gather in an aftermath of a storm, Cole?
Well, you'll need documentation for all of your tangible property, such as your home, your car, and other valuables as well.
What about businesses? Do they need documentation too?
Well, absolutely. If you own your own business, you need to document all of your lost inventory.
Where should I start with reconstructing my financial paperwork?
Well, the first step is to call your bank and credit card companies. They can help you start putting the pieces back together again.
So, what do people need to be aware of in disaster situations or after a disaster has struck?
Well, you'll want to be aware that the IRS may postpone tax deadlines for people who experience natural disasters.
Oh, they did that for people in Florida after Hurricane Ian hit, didn't they?
That's right. The IRS extended filing deadlines for all of those folks.
It's great to have extra time to file your taxes because it's so hard to do that when everything is in disarray. But you'll want to know when the new deadline is because you don't want to end up missing that.
Absolutely. That's a great point, Logan. It seems to me that people are so used to filing on April 15th that if the deadline gets extended, it's very easy to forget what that new date is and end up potentially missing it. And you don't want to have to deal with whatever penalties you could face for missing that deadline on top of a natural disaster.
How can you find out whether you're eligible for an extension?
You should contact the IRS or check out their website. They have a page titled Tax Relief in Disaster Situations, and it lists disaster relief eligibility by state and by date.
There's also information about reconstructing your documents on that page. Now, moving on, what about the states? Do they offer relief too?
Well, usually the states will align with the IRS. If the feds extend your deadline, the state likely will too. However, things get sticky when you file in more than one state. If you live in Wisconsin and there's a tornado, the state's extended deadline will apply. But if you also work in Minnesota, you likely won't get an extension for filing your taxes there.
So what happens if you do miss the state's deadline?
Well, when you file, you can include a notation explaining the delay in filing.
Okay. Could you also file and then when they notify you of the penalty, could you respond with a reasonable cause and explanation?
You may be able to do that. Rules vary from state to state. If you file taxes in more than one state, it may not hurt to find out what the requirements are just in case.
Got it. Now let's get into the weeds about assembling and recreating records.
Getting into the weeds is a good choice of words for that task. As we've already touched on, individuals need to document their real property, vehicles, and personal property. Businesses need to list their lost inventories.
Why is that, Cole?
Well, as we mentioned at the top of this segment, you need to have these documents for insurance reimbursement and for filing taxes. You also need records to prove that your property losses are the result of the disaster. If you're able to accurately estimate your losses, you may be able to get more recovery assistance through grants and potentially loans.
What are the primary disasters? We've talked about tornadoes, but those are certainly not only disasters that can upend our life.
Well, that's right. Disasters are typically things like fires, floods, and hurricanes in addition to tornadoes.
All right. So disaster has struck. Where do I find my records?
Well, on the IRS website, you'll find the Get Transcript Service page, and there you can get your own transcripts and download them or have them mailed to you.
Is there a cost associated with that?
No, it's actually a free service that the IRS provides. You can also call. There's an automated phone transcript service, and you can reach it by calling 1-800-908-9946. You can order a tax return or tax account transcript to be sent by mail.
What about financial institutions?
Well, you should visit the websites for your credit card companies and your bank. You may be able to find your documents online there.
Where should I get documents related to my home?
Well, try contacting the title company or the escrow company. The bank that handled your home purchase is also a good place to reach out to.
Makes sense. What about inherited property?
Check court records. Probate values should be shown there. If your property is in a trust, contact the attorney who set up the trust.
What if you can't find any of these records?
You can always try checking your county assessor's office. They may have old records that verify your property's value also.
What's another source people can reach out to for their records?
Well, here's one that's often overlooked. If you've had work done on your house, try reaching out to the contractor. They will likely have a record of contracts, invoices, and proofs of payment. You can also request statements that verify the cost of the work that they did.
Okay, what about getting written descriptions from neighbors or friends who can confirm that the work you have done on your house?
Well, that's a great option. After all, you probably talked to your friend's ear off about your kitchen renovation, right?
Yes. I would never do that.
Of course not. Well, odds are your friends, neighbors, or family members know something about the work that you did on your house and can write up a little description for you.
Let's talk about personal property. How can you document that so you can get reimbursed for your losses dealing with that?
Well, the article recommends looking at photos that you may have taken with your mobile phone. Look for photos that you may have taken inside your home that might show the damaged property in its pre-disaster condition.
That's a great idea. Yeah. What else?
Well, you can also do some research online to establish the costs and fair market values of the items. You can also use things like canceled checks, receipts, videos, and photos as evidence of the value of the object.
Still making sense. What about contacting your credit card company to get a record of how much you paid for something?
That's certainly another important step, Logan.
What if you have no photos to go by? How can you make an inventory of things you've lost?
Well, the article recommends making sketches of your home. Sketch a floor plan and include where every piece of furniture was. Sketch tables and shelves and everything that's on them. Be sure to include items hanging on walls, and don't forget closets, basements, and also attics.
That sounds like a lot of work.
It is. But as the article points out, after a storm, your goal is to recover as fully as you can. And to do that, you have to document your losses and get your paperwork in order.
What about contacting your financial services professional? Would they be able to help?
Sure, if your financial services professional has a list of your assets, and if they offer a digital storage option like our generational vault, you can store all of that information securely and access it easily in the event of a natural disaster.
Now there's a great idea, Cole. I think we're out of time for this segment. Viewers, if you would like to learn more about our generational vault, contact us at retirewithbuska.com or call 715-355-4445. We'll be right back with more Financially Speaking after this. Thank you for tuning in to this week's edition of Financially Speaking. We're glad you were able to join us today, and we hope you learned some useful retirement tips along the way.
On today's show, we covered a number of important topics, and hopefully we did so in a manner that was easy for you to understand. This is the same way that we communicate to our clients when we meet with them in person. Remember, with the help of the right financial services professional, you can create a quality retirement, and our team is here to help. Right now may be a great time to get a second opinion on your retirement plan, so call us at 715-355-4445 or go to retirewithbuska.com to continue your retirement education, catch up on some previous episodes of our TV and radio show, or to schedule your complimentary, no-obligation consultation.
If you have any questions or comments about today's show, call us at 715-355-4445 or feel free to send us an email at info@retirewithbuska.com. Join us next week at the same time and same place for another episode of Financially Speaking.